Ladies and gentlemen, good day and welcome to Bajaj Finserv Ltd Q2 FY26 Analyst Conference Call hosted by JM Financial Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raghavesh from JM Financial. Thank you and over to you, sir.
Thank you, Neerav. Good evening, everyone, and welcome to the Q2 FY26 earnings conference call of Bajaj Finserv Ltd. First, I would like to thank the management of Bajaj Finserv for giving us the opportunity to host this call. As always, we will have opening comments from the management team, post which we will open the floor for Q&A. From the management side today, we have Mr. S. Srinivasan, President, Insurance and Special Projects, Bajaj Finserv Ltd. Mr. Ramandeep Singh Sahni, CFO, Bajaj Finserv Ltd. Mr. Tapan Singhal, MD and CEO, Bajaj General Insurance Ltd. Mr. Tarun Chugh, MD and CEO, Bajaj Life Insurance Ltd. Mr. Avais Karmadi, CFO, Bajaj General Insurance. Mr. Vipin Bansal, CFO, Bajaj Life Insurance. Mr. Ashish Panchal, MD and CEO, Bajaj Finserv Direct Limited. Mr. Devang Modi, MD and CEO, Bajaj Finserv Health Limited. And Mr. Ganesh Mohan, MD, Bajaj Finserv Asset Management Limited. With that, I would like to hand over the floor to Ramandeep sir for his opening comments. Thank you and over to you, sir.
So good evening, everybody. We welcome everybody to the conference call to discuss the results of Bajaj Finserv Limited, BFS, for Q2 FY26. As before, in this call, we will largely be concentrating on the consolidated results of BFS, the results of our insurance operations through Bajaj General Insurance Limited and Bajaj Life Insurance Limited. Our emerging companies, which include Bajaj Finserv Health, Bajaj Finserv Direct and Bajaj Finserv Asset Management Company. And lastly, where material, the standalone results of Bajaj Finserv. Bajaj Finance BFL and Bajaj Housing Finance BHFL, other major subsidiaries of ours, have already had their conference calls, and hence we would pursue only very high-level questions on these two entities. To start with a few hygiene points, as a word of caution, we affirm that any statements that may look forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance result. Let me also give you an update on the basis of accounting across our companies. As required by regulations, BFS prepares its financials in compliance with the Indian Accounting Standards, Ind AS. However, the insurance companies are not covered under Ind AS currently. They have hence prepared Ind AS financials only for the purpose of consolidation. Accordingly, for Bajaj General and Bajaj Life, standalone numbers reported in our deck are based on non-Ind AS accounting standards, Indian GAAP, as applicable to insurance companies today. We also confirm that our results, the press release accompanying the results and our investor deck have been uploaded on our website within half an hour of our results. Now to just give an update on our joint venture with Allianz, I'm happy to confirm that necessary approvals for the acquisition have been received, namely from CCI, IIDAI, and also the approval for name changes of the two companies have been received from ROC. Post these approvals, the names of our two insurance companies have now been changed to Bajaj General Insurance Limited and Bajaj Life Insurance Limited. We are now preparing to conclude the acquisition of Allianz's stake in our insurance companies in the next few months. Let me now give you a high-level update on the consolidated financial results for Q2, which have been put up in our press release issued earlier today. The consolidated total income grew by 11% to about 37,400 crores versus about 33,700 crores for the same quarter last year. Our consolidated profit after tax grew by 8% to 2,244 crores, up from 2,087 crores for the same quarter last year. As we know, this gets a little vitiated by the MTM gains and losses from the insurance subsidiaries, and hence excluding the MTM movement of the insurance companies, if you look at the profit growth as compared to the reported growth of 8%, the growth would be a healthy 12%. Let me now deep dive and give you further texture on the performance of each of our companies. To start with Bajaj General, as we know, effective 1st October 24, as was mandated by IRDA, premium on long-term products was to be accounted on 1/n basis, where n is the contract duration. Hence, the Q2 FY26 numbers are not comparable with prior years. The change in accounting, however, has no material bearing on the underwriting profits and profit after tax, but impacts the gross written premium and the combined ratio for the period. The gross written period for Q2 for Bajaj increased by 9% to 6,413 crores versus 5,871 crores for the same period last year. However, excluding the 1/n impact, the growth was a healthy 13.6%. In terms of GDPI, the growth was 9.3% and against the market growth of only 1.8%. We also disclose our numbers of GDPI excluding the bulky tender-driven businesses. And if you look at the growth of our company, excluding these bulky businesses, which is crop and government health, and excluding the impact of 1/n, the growth is healthy 18% as against the industry growth of 13.4%. So good for 1.5 to 5% delta above the market in terms of GWP growth. The GWP growth is largely different by the profitable commercial lines, which include fire, marine, engineering, and liability, and also the motor and miscellaneous lines of business. Moving to the underwriting loss, the same stood at 92 crores for the quarter, as against 48 crores reported for the same period last year. The reported combined ratio stood at 102.3 as against 101.4 for the same quarter last year. Excluding the impact of 1/n regulations, the combined ratio for the quarter stood at 101.4, flat compared to the same period last year. Underwriting losses, as indicated earlier, are little on the higher side, impacted by higher acquisition costs with the focus on writing preferred lines of business. While higher than 100%, we believe that the combined ratio for Bajaj General will still be amongst the lowest in the multi-line market, with the ROE reasonably above 20%, excluding the surplus capital. The profit after tax for the quarter stood at 517 crores as against 494 crores last year, an increase of 5%, as indicated earlier, impacted slightly by the higher acquisition cost during the quarter with the focus on preferred business segments. The AUM for the period ended 30th September 25 stood at almost 35,000 crores versus close to 32,000 crores for the same period last year. In summary, in a market which is intensely price competitive, Bajaj General has once again been able to outperform the market both on top line and bottom line. This operating result, we believe, displays Bajaj General's commitment to a balanced and a profitable growth on the back of a deep and a broad distribution and prudent underwriting while focusing on best-in-class customer service. I'll now move to Bajaj Life. Bajaj Life 2.0 was initiated in the second half of last year with focus on sustainable and profitable growth. We believe that the outcomes in Q2 are as expected, with top line flattish and VNB growth and NBM margin expansion in line with our plan, backed by changes in product structures, as was indicated earlier, and cost optimization. The impact of change in strategy is now reflected for the third quarter in a row, and Bajaj Life registered highest ever reported VNB and NBM numbers for the quarter and for the half year. During the current quarter, the company's profitability was impacted by changes in the GST regulations applicable to all the retail life insurance products, particularly due to the loss of input tax credit. The VNB for quarter 2 is reported at 367 crores as against 245 crores for the same period last year, a significant 50% increase versus last year. The new business margins were up at 17.1% for the quarter as against 10.8% reported for the same quarter last year. Retail protection grew at 71% with 8% contribution to the overall retail weighted received premium, and the group protection grew 23%. On the back of continued strong renewal premium growth of 30%, Bajaj's GWP grew 28% during the quarter. There were some persistency dips observed across some cohorts in line with the industry, which is being worked upon by BALIC. On overall retail weighted received premium, while the growth was flattish in line with our plan, the product mix for quarter 2 was well balanced and stood at par with 21%, non-par savings at 20%, term at 8%, annuities at 9%, and ULIPs at 43%. Bajaj Life has been increasing its focus on retail protection, which I indicated earlier has grown at 71% to 144 crores for the quarter versus 84 crores of premium for the same quarter last year. The profit after tax for the quarter stood at 13 crores as against 148 crores for the same period last year, but largely on account of the impact tune of 112 crores. Bajaj Life ended the quarter with an AUM of 1,32,060 crores. Overall, the quarter for Bajaj Life is in line with the expectation and on the right trajectory of sustainable and profitable growth. Finally, both the insurance companies are financially amongst the most solvent in the industry. Bajaj Life with 346% solvency, Bajaj General at 339%. Hence, we are well placed to weather any external adversity. With respect to the two insurance companies, we welcome the government's landmark GST reform aimed to making life and health insurance affordable and accessible. We have ensured that the full benefit of the GST exemptions are passed on to the customers. While the withdrawal of input tax credit may create short-term pressure, we are confident of managing this in the next couple of quarters. We also believe that the GST exemption on retail life and health insurance premium is a tailwind for the industry in the medium to long term, as it makes insurance more affordable and accessible to all. We would also like to reiterate that insurance is a long-term business and we remain steadfast in our commitment to drive profitable growth, create sustainable value and always prioritize our interests of the policyholders. Let me now move to the lending businesses, BFL and BHFL. For Bajaj Finance, a good quarter on volumes, AUM, OPEX and profitability. Number of new loans booked in the quarter was at about 1.2 crores as against 0.97 crores for the same period last year, a growth of 26%. The company's diversified business model has enabled it to record a strong AUM growth of 24% at 4,62,000 crores as against 3,74,000 crores in period last year. Net total income grew by 20% to about 13,170 crores as against 10,946 crores for the same period last year. Profit after tax grew at a healthy 23% during the quarter, up to 4,948 crores from 4,014 crores. OPEX to net total income improved to 32.6% as against 33.2% in the previous year, with green shoots of AI initiatives now visible. The net losses and provisions for the quarter were up 19% and the credit costs remained elevated largely due to the two and the three-wheeler segment and the MSME business. However, the company has cut about 25% of its unsecured MSME volumes, and thus the AUM growth for MSME lending will be close to about only 10 to 12% for the full year 26. In terms of the gross and net NPAs, they stood at 1.24% and 0.6% respectively as of 30th September, as against 1.06% and 0.46% for the same period last year. We believe that we will continue to be amongst the lowest in the industry as far as NPAs are concerned. The capital adequacy remains strong at 21.22%. Moving to Bajaj Housing Finance, a stable quarter with AUM growth of 24% despite heightened competitive intensity and higher portfolio attrition. Growth was very well distributed across all the business segments. Home loans AUM grew by 19%, loan against property by 29%, lease rental discounting by 35%, and developer finance by 25%. Net interest income grew 22% to about 1,097 crores as against 897 crores for the same period last year. Operating efficiencies in terms of OPEX to total net total income improved a healthy 19.6% as against 20.5% for the same period last year. Healthy asset quality was maintained with gross and net NPA standing at 0.26% and 0.12% for 30th September as against 0.29% and 0.12% for the same period last year, which we again believe is amongst the lowest in the industry. Profit after tax grew at a healthy 18% to 643 crores. Capital adequacy was at a healthy 26.12% for the period ended 30th September. In summary, another very strong quarter for both our lending companies, Bajaj Finance and Bajaj Housing Finance Limited. Now, let me give you an update on our emerging companies. To start with, on Bajaj Finserv Health Limited. In quarter 2, Bajaj Finserv Health did about 6.2 million health transactions versus about 2.4 million transactions for the same period last year, which were accelerated significantly through a few large government contracts and commencement of OPD business with few insurers. Bajaj Finserv Health continued its expansion of provider network, which includes about 133,000 doctors, about 5,700 lab touch points, and about 16,000 hospital tie-ups. Utilizing this network strength and its tech platform, Bajaj Health is able to offer integrated OPD, IPD, and wellness experience to both retail as well as corporate customers, which is a unique proposition in the market today. During the quarter, the revenue from operations have grown at a healthy 22%. Moving to Bajaj Markets, during the quarter, the BFSI lending disbursements by Bajaj Markets stood at about 1,549 crores as against 1,210 crores for the previous quarter, which is quarter 1 of FY26. The company ended with a total unique partner count of 101. The top line for the company, however, has registered a planned degrowth of from 164 crores last year same period to about 90 crores for the quarter this year, which is attributable to decrease in loans and transacting customers during the quarter. The degrowth was planned for due to a system migration for frontline sales, and the company is now migrating to SFDC as a tool for managing CRM for the frontline sales. There has been no capital infusion in the company since March 22, showing capital efficacy of the company. On Bajaj Finserv Asset Management Limited, the AMC company continued its good run, recording an AUM of 28,815 crores as of 30th September, moving to the 25th position amongst the 47 mutual fund companies in India in terms of AUM. And as of date, the company has already crossed an AUM of 30,000 crores. The AUM grew by 15% from the immediately preceding quarter and 77% from the same period last year. We believe that Finserv AMC is the fastest to cross the 25,000 and the 30,000 mark in less than 2 full years of operations. The equity mix for the AMC companies stood at a healthy 52%, and the non-group share of AUM constitutes about 86% of the total AUM. That's from my side on the performance updates. Before we open for questions, considering the paucity of time, I request the audience to keep their questions brief so that we can cover more queries during the call. With this, I invite questions from the audience.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Mehak from Emkay Global. Please go ahead.
Yeah, hi. Thank you for the opportunity. So, my question was on BALIC. So, just wanted to understand the breakup of this 140 basis impact on VNB margin, which is on account of the GST. So, if you could just help us with the breakup between the renewal and the business done after 22nd September. That was one. And secondly, how do you look to kind of mitigate the impact of GST ITC losses? Will you kind of revise these distributor commissions, or how do you plan to mitigate this impact? These are my two questions.
So I'll just answer the quantitative bit for Vipin to handle, and then maybe I'll come in with the qualitative one.
Yeah. So on the H1 basis, we have 140 basis impact on the NBM.
Sir, sorry to interrupt you. You're sounding a little distant.
Okay. Is this better?
Yes, sir.
Yeah. So on H1 basis, the impact on NBM is 140 basis on account of GST. 50 basis of this impact is back book. That is for the business that was written from April to 21st of September, because on the renewal commissions that we will pay in future, we will not get ITC credit. So that's 50 basis out of 140 basis. Rest 90 basis is for the business that was written from 22nd September to 30th September. Now, while I'll call this out, it is important to note that the business mix that was issued from 22nd September to 30th September was skewed towards non-ULIP, because we had given an option to the customer that you could decide to have your policy issued immediately or wait for GST exemption to kick in. And in the case of most non-ULIP customers, we chose to get it issued after 22nd September, which was logical because it was becoming GST exempt. So hence, the 90 basis that we are talking about is only reflected for that 8-day period, 9-day period, and that has a skew of, like I said, non-ULIP mix. If I was to annualize this is the mix that we typically operate, and if we were to do nothing on ITC or the GST, as you were saying, the impact should be about 450 basis. Mind that helps?
Yeah, perfect. And secondly, on how would you look to mitigate this whole impact?
Yeah. So this is in the works, Mayank. Some actions we've already taken on, and I must say that quite successfully. A lot of this has been in terms of product structures and product mixes, and that is something we shall keep working on for the next 2 quarters. We are also in discussion with distribution on how to take this burden of GST, which overall I think other than the ITC part, the rest of GST has already helped in growth, and the tailwinds are setting in. It's quite obvious that customers are seeing prices are down. So we are now working with distribution and not just us but the sector together on how we can share this ITC burden with our distributors, our vendors, and of course how we can ourselves parry it down. We expect another 2 quarters for settling this entire process and taking all measures that we are intending to take. I guess by the end of that we should be firmly placed.
Got it, sir. Thank you so much. That's it from my side.
Thank you. Participants, you may press star and one to ask a question. Next question is from the line of Sanket Godha from Mendes Park. Please go ahead.
Yeah, thank you for the opportunity. If I negate the impact of, say, for 140 bits of the VNB, then you almost reported maybe closer to 16% margin, or more than 16% margin for 1H FY26 compared to 9.2 what you reported last year. So means in the presentation you mentioned that it is product mix, cost rationalization, and better product margins. So if I want to break down this 7% delta improvement in the margin, how much, if you can give a bit of color, how much was led by product mix, cost rationalization, and maybe better margin profile of the products, basically, just to understand a bit more whether this is sustainable or not. That's my first question. And second, on BALIC is largely on you will enter into a favorable base now from second half. So can we expect a growth to come back in teens for you in second half, or the disruptions with respect to GST renegotiating commissions will have its own bearing, and therefore growth for the full year can be still pretty muted, or might be little difficult even in second half? So these are the two questions I have on BALIC.
Yeah. So Sanket, let me pick up the, broadly the walk of the margin that you spoke about. So, look, we have mentioned in past, the cost optimization that we were doing, that is giving us anything between 100 and 125 bits of margin expansion. So that's with respect to cost. If I have to give you a broad breakup on the mix, I think anything about 400 bits is coming out of the mix. Rest is coming out of product repricing, and then there'll be obviously some compensating items, because like everybody else, our credit protection business continues to see intensive competitive pricing pressure, and there we are seeing some margin compressions. So that's offsetting. Our volumes are a little low, so cost absorption is making an impact there. But broadly, if you were to ask me, cost would be about 125 bits. Product mix would be about 400 bits. That's broadly, I could talk to you about 525 bits. I think rest would be multiple line items there.
Understood. And then from the full year point of view, you think we will have this delta of 500 to 700 basis point net of earnings, not factoring the GST negative impact? Will we hold up, or if I take an annualized impact of 450 basis point on the margin, is it fair to say that we will end up at a high teen margin for the full year?
So let me break that into two parts. First, like Raman said, look, we started this journey in second half of last year. And, March was the first full quarter where this entire change of Bajaj Life 2.0 was starting visible. Now, March quarter was 4% margin expansion. June was 4.2. This quarter, depending on whether you look gross or net of GST, we are upwards of 5.5%. Having run that for 3 quarters, it does give us confidence that the journey that we took on margin expansion, we are on track. Now, I think at this point of time, I would not want to hazard a guess whether it will be 4%, 6% or 7% margin expansion. But I think we are looking at a significant consistent margin expansion, and I think that strategy is working well for us. And to call out, it is not only margin, absolute VNB rupee value is also growing. So that gives us a lot of confidence that our strategy is working. Now, having said that, like Tarun also mentioned, I think probably 2 quarters we will have this noise or impact of GST. It's a transient impact. We do believe over next 2 quarters we should be able to mitigate most of it. So I don't know if I could answer your question on full year basis for this year, because there'll be a noise around H2. But had that not been there, I think our confidence level in terms of margin that we have been saying that it should expand in the range of 4 to 6 in this year would have definitely happened.
Understood. And on the growth, the second question which I asked, given if you will have units,
Yeah, so I'll just step in on that, Sanket. You've got it right. The studied strategy that we had on a flattish 4 quarters is over, and that ended September. And here on, you should see a significant trajectory on growth. I would at this point not hazard a guess will it be above the industry, but I won't be surprised if it is. And I think this is supported by the fact that the GST impact in terms of the tailwinds that it's giving will also be a significant part. We've already seen growth coming in the proprietary sales, in the bank assurance side. Agency, of course, is some legs are still not steady, but bulk is under control. And we expect that is unfolding, and that will be more visible now in this coming quarter. Base effect notwithstanding, it will still be favorably good quarter, I assume, in terms of the top line. So no worries on that count.
Understood. Thanks for the answers. Now, just on Bajaj, a couple of questions, small questions. See, when I look at your motor business, there seems to be a significant divergence when it comes to OD growth and the TP growth. Maybe just wanted to understand this divergence will continue or how it will play out, and related to that, given the TP growth is very strong, no price hike, and this loss ratio for what you are reporting around 59% in TP is really sustainable or not is the question I had on motor. And largely, and second thing is that the group health, PA and retail health growth being muted in first half with 1/N accounting trading in second half, can we expect the growth to go back in high teens to 20s in towards?
Thank you for the question. I think first and foremost, if you have seen our philosophy for a long period of time, it's very simple. We try to maintain our market share, in all lines, sub-lines of businesses, and pick up good risks and serve the customer very well. I think it's a very simple philosophy that we follow, which we have been doing for so many years. So the question on TP, we look at our TP market share had become lower than what our OD market share was. So if you currently see, and that's why you see this difference, we are trying to get that to be where it is. So that in a way brings us to the place where it is. On the price hike of TP for quite many years did not happen, which means that our belief is that it should happen very soon. Now, how soon will that be? That we can't tell because the government decides that. But because it's been overdue for quite some time, it should happen soon. And that is why our belief is that this should play out well. On the group health and PA perspective, see, if the market does not give an opportunity to pick up risk at our price, which we feel is right, so that we can serve the customer well, then we don't do that, and which is how it is. When we see that opportunity, we do that. So to tell that whether in the next half we will pick it up or not pick it up, it will all depend on the market and the pricing that we are comfortable with. The moment it reaches the range where we are comfortable with, then you see that we pick up the business which is there. So that has been our consistent philosophy for many years, and we continue doing so. Thank you for the question.
Okay.
Sanket, I'll just add to Tapan's point. See, I'll just give an indication on where is the TP growth also coming from, and that also takes us to the point, which I'm sure somebody will ask in the due course, is on the higher acquisition cost. So if you look at our two-wheeler new market share, as you recall, few years back it used to be 3% levels. We had moved it up to about 8-9% levels. For the quarter, it's hovering around 13.5 to 14% levels. And because we end up paying commissions upfront for 5 years, that's why the acquisition cost has moved up. And this also leads to your point on TP being higher. As we know, in two-wheeler, the proportion of TP is much higher, and that's why you're seeing TP growth also higher. So there are some segments which we know will deliver profits, and hence the focus is there. But like Tapan said, we'll have to, while our endeavor is to grow TP market share, where we were lagging, but we'll also have to see how we manage the profitability on that front. Also, on the point you made on health, see, there are two elements. One is you spoke about the group health. Tapan answered the GMC piece. The other point which you said is true that, from the base now, the 1.n impact will get neutralized to some extent, so that we should start seeing some benefit of that in the reported numbers. However, anyways, we've been reporting growth excluding 1/n, anyways, we've been transparent on that. To the other point on retail health also, if you see, while our growth is looking muted, but that's also because of long-term business. While I think we reported a muted growth of, I think, less than 1% for the quarter on retail health business, but if I exclude the impact of 1/n, the growth is actually 11% for the quarter. And in fact, if I see the growth for the month of October, it's about 15%. So that's how the numbers are shaping up.
Thank you, Raman. This is very useful. It clarifies my question. Thank you very much.
Thank you. Next question is from line of Madhukar Ladda from Nuvama Wealth Management. Please go ahead.
Hi, thank you for taking my question. First, congratulations on a very strong, result in BALIC. So we're seeing a very sharp increase in margins and VNB. And also, my question was more related towards the product mix. So I think you've been able to change the product mix very successfully towards higher protection. Even on a quarter-on-quarter basis, we see protection has grown very strongly. And sort of non-par and annuity also, which are the higher margin segments, there also we're seeing a good pickup. So I wanted to understand, what is driving it and how sustainable, in your opinion, is this growth in protection? And obviously, I'm guessing there's also a tailwind on GST. Some comments around whether this is continued in October and how would you see this in the second half will be helpful for us to sort of judge what the margins can be for FY26, given the hit of ITC is also there, right? So yeah, some comments around that would be helpful. Thanks.
So I got bulk of your question, Madhukar, and I'll attempt to answer that. If you feel that I haven't answered perfectly, you please append it. But yeah, thanks for acknowledging the fact that we've been able to get the product mix altered significantly. This is exactly what we told you a year back, that the results have been a little better than what we expected, honestly, exactly as you are also kind of commenting. But more and more we've seen that we've still got significant room to move on the protection side, and the story is still consistently there. For example, I'll just throw some data points. 33% of our customers are getting onboarded as protection term customers. 17% of our customers, additional to this, are getting added on some rider or the other. So very clearly, 50% of the customer base has some element of protection easily in it. We did see an opportunity, and we did find an innovation opportunity on the annuity side, which was vacant, and we were the first ones to make the move. In fact, if I might so claim that on annuities too, we were the first one with the deferred annuities a few years back, and now we've been moving on the maybe short-term pay annuities, and which has worked well, particularly in the 50 to 70 age band. In addition to it, about 10% of our high sum assured units is about 8 to 10% of our entire mix as well. So the unit part has also moved. All of this was kind of mentioned to us and promised to all our stakeholders last year, and I think we've come alight on that. There is innovation more so in term as well, which we've done, which maybe as let it succeed, we shall disclose. It's already showing the good green shoots that you see, and I'll claim more when I've consistently got that experiment working on term, which is a different segment of approach. All this, I think, more to come as we go. I think we've been surprised and pleasantly surprised and are more bullish about a direction in which term plan can go. And you should, as you work on Excel sheet, your second leg of your question, yes, we will be holding this product mix broadly in the medium term. So again, we don't have any worries on this. As last year we had moved to BALIC 2.0, there were significant steps we took, not just on product mix and product structures, but also on cost optimization. So if I may, that cost optimization, there is still room in that direction, and you will see that in the next 18 months, more and more of that happening. So yes, the direction is positive. Have I answered your question, Madhukar, you believe?
Yeah, most of it. Just on protection, in the first half, I think the growth is like almost 70% year over year. Some sense on, what is driving it? Do you think it is initial sort of GST reduction and it would sort of come off after some time, or is there something more to it?
Growth, Madhukar, year on year is a difficult one because the base has already gone up. I think it's more to do with every channel basically picking it up significantly. The GST impact, only we've just about seen how much, about a month of it, and October, as you know.
Less than that. Yeah.
The GST impact, if any, the whole sector will still get the benefit of that for the future. We've been working on our underwriting, analytics. I had talked about our analytics a few times earlier. A profiling of customers, pre-profiling, democratizing it more in business channels, and I do see some headroom even more available there. The way we worked our term strategy, like we do any other strategy, is ground up, segmented, and not just one fit all. I think that's been working. Our processes with AI at the back end, digitization has worked out quite well. And like I said, we'll talk about more of this as the experiments go ahead. I think there's been more to say.
So Madhukar, I think two things here. If you look at the 70% odd growth that you're talking about, I would just draw your attention to looking at this data for last 18 to 24 months. And this retail protection growth has been largely consistent. I think that's point number one. So it's not that it just came this quarter or this H1. It's been consistent for last 18 to 24 months. I think point number one. I think point number two, to what Tarun alluded, I think when we came in and talked about Bajaj Life 2.0 last year, similar time, I think these were all conscious efforts thought through with set out actions that we had in our mind. And, as we called out earlier, as I did mention earlier, I think as we were executing this, it was all about what we had planned for and how do we execute them. And I think we have been pretty successful in executing what we had planned for. So we have said that in medium term, that's in about 2 to 3 years, our term protection share should be 10% odd. And I think we are rightly headed in that direction.
Great. Congratulations and all the best. Thanks.
Just to add, I think when you look at the life business, a very long-term business. And if you look at the history of BALIC, at least over the last 7-8 years, when we started the transformation, I think 2018, without any external regulatory change or anything, we took a call that we want to reduce ULIP from 72% by taking a big jump onto the traditional business. It did result in 1 year of lower growth because ticket sizes for traditional business were much lower, but I think the team executed very well. Last 3 years, we have seen several headwinds. We had first the tax on ULIP, and the tax on traditional, and the surrender charges, and now the GST. Now, each of these really requires the company to review where it stands, and we had started BALIC 2.0 with a very clear intention that we want to focus on consolidating the growth that we achieved in BALIC 1.0 with a greater focus on profitability. And I think at least the results so far this year indicate that BALIC is on the right track. The number of customers are growing. The percentage of customers who are going to be profitable in total mix are growing. We have cut out businesses which we believe will not give us profit. At least a small segment of customers who disproportionately contribute to the losses have been avoided. And all this has come through a mix of product and distribution strategies. As we go forward, I think this will remain the principle of BALIC, and we will continue to focus on this. There are other headwinds as well. For example, the yields coming off has taken a bit of a hit on the non-par guaranteed business because they're no more attractive as they were till about a year and a half back. So these things cyclically will play out. And the question is how nimble you are in terms of your ability to adapt. And group protection is another one which is showing good growth of 23%. And last 2 years we have seen, because it is based on the lending of the banks and NBFCs, it has been a bit volatile and patchy and not that great. But now it has started picking up. Our smaller banks, which we tied up the last few years, are growing significantly well, which is also adding to margins. So I think overall, when I look at it long term, the company is positioning itself in the right manner in terms of product mix and the distribution mix.
Great, sir. Thank you. All the best.
Thank you. Participants, you may press star and one to ask a question. Next question is from line of Nidhesh Jain from Investec India. Please go ahead.
Thanks for the opportunity. So first question is on listing of life insurance and general insurance business. Any plans to list these companies separately, given that in the past we have heard that there is a regulatory push also to list larger life insurance and general insurance companies. And in the last deal also, your promoter group has taken a stake in these companies. So any plans to simplify the structure or list these companies in the medium term?
I'll take that. I think at the moment our focus is on completing the acquisition. While we have changed the brand and effectively are in control now, the transaction is not complete yet. It will get done over the next few months. At least a substantial portion of that will get concluded. That is the first step. We are also with a new brand in place for the next 1 year. We have to be very watchful in both the companies in terms of retaining the business and ensuring that we continue to grow and establish the Bajaj brand in a more firmer way. Not that it is not known, but I think it's a change of brand for the company. After that, we will have to review. It is something I don't think in the next 2-3 years we are seeing anything. We have other developments in the industry. We have Ind AS coming up. We have RBC coming up, and then IRDA is making progress on that with successive interactions with the companies. I think for the next 2 to 3 years, they will all play out. They have a big impact on the way numbers are reported, how the profitability is measured, and it could have some tailwinds as well. At least our preliminary look at it seems to indicate there are some positives, especially for companies which are significant solvency. And therefore, we are positioning ourselves. But once that plays out, we will review it. We do have excess capital in both the companies. In the case of life, we are consuming it, and hopefully we are consuming it very well for the right products and the right growth. In the case of non-life, we are generating capital, and so we will review that. I think the boards of the company will review it at the appropriate time. But if you ask me, next 2 to 3 years, because of all these external developments, we also have the insurance bill, which may come up any time, which has these changes in the Insurance Act with 100% FDI, potentially composite licenses, ecosystems, many things. So all these have an impact on how you look at your long-term strategy, and therefore we will wait for all these to play out before we take a view on what to do with this.
Sure. The second question is on Bajaj General Insurance. In Bajaj, we have been in the past we have been operating at below 100% combined, but in the last couple of years the combined ratio has been consistently above 100%. So what are the reasons for that, and how do you see possibility of combined ratio below 100% over medium term?
So the point to be seen here is, if you look at the industry combined ratio, it has been over 115, between 115 and 120. So Bajaj has been beating the industry combined ratio by full 15 percentage point. It's not percentage, but full 15 percentage point. And consistently for so many years. So even now, when you see the delta in combined ratio, and Raman mentioned that in the opening speech, 1 by N also pushes it up by at least a percentage point, which is up there. And secondly, when you acquire businesses which has acquisition cost being paid upfront, the accounting puts it like that. And that's why Srini was alluding to. If you look at the accounting system which is internationally followed, then the combined would be much below 100. It is there. So when you're growing those kinds of businesses, the expense moves up, because you're paying it upfront and you account for it upfront. And also 1 by N is also playing a bit of a role in that. But broadly, if you see our, ambition has been to be close to 100 at all points in time, which we are doing. But what you should be appreciative about is that this is one company which consistently for decades now has been outperforming the industry by full 15 to 20% full points in combined ratio, and still growing the number of customer base, still being like last year also pick it up. We have issued the largest number of policies in the industry. Nobody is even close to us. Growing the customer base, capturing market share, moving up the ladder, and maintaining this delta in combined ratio. This is what, and I'd be very surprised to find more companies which can deliver these kind of results consistently for such a long period of time. So that is why it is. So it's not a question in which you should feel alarmed or something. It is just the way it is structured. And if the new accounting system is followed internationally, if you look at it, then the combined comes way below 100, when that comes into play. And that's what Srini was alluding to when he spoke about that what the regulator is looking at in terms of bringing those accounting system which is being followed internationally.
I think, Nitesh, one more thing you have to notice is that in the long run, any P&L business like general insurance is an ROE business.
Nitesh,
Srini, what got dropped? Yeah. So I think what Srini is also alluding to is that if you look at, and if you bring the capital, though requirement is 150 for solvency, even if you take it at 200, and Raman correct me wrong, the ROE for Bajaj is over 20%, even currently, I think around for second quarter is 27 or so percent, ROE that we're delivering. So this is the kind of return of equity we're delivering, and that again, when the industry equity ROE is at 3%. So the outperformance of Bajaj to the industry is by these margins, which should be there.
Sure. Hello?
Nitesh, one more reason why this is happening is we indicated earlier that we are writing more and more of longer term business. So for example, what I indicated earlier on the two-wheeler side, 3 years back my market share on two-wheeler was only 3%, this quarter it was 13%, and having to pay upfront for 5 years of commission, that causes new business strain, the life sense, what we call it. So that is one reason why the combined ratio is looking elevated. And similarly, even on four-wheeler, our market share is now hovering about above 9%, which used to be close to 7.5% is what I remember 3 years back. So overall, our long-term businesses are much higher than the industry. That's why we are, in the last few years, you've seen this delta.
Sure. And in the motor business, I have noticed that motor OD ratios have increased to 71%, which is on the higher side versus that historical trend. So any change in any trend reversal in this business, or just a quarterly blip?
So it's just a quarterly blip. We will come down by the year end is what we believe. With all the actions we are taking, we will come down to normal levels for full year is what I believe.
I think, Nidhi, historically, whenever there is a increase in loss ratios, Bajaj always puts in place a risk reduction mechanism. We have a very 20-year history of being able to come back by looking at segments where we should slow down, where we should get more aggressive. And that process will continue. Every time there is a blip, there will be action taken by the company. And eventually, but it takes a bit of time because it's a one-year contract. It may take 3-6 months for it to play out, but we will continue the journey and we'll continue doing the right thing that we have done in the past.
And let me explain the blip also. See, what happens is, in the beginning of the year, the OEMs increase their charges for labor, spare parts. So this happens, like in most of the years, you'll see this blip initially happening, and then, like Srini said, the company keeps on taking corrective action, and then it gets it there. So it will be a phenomena that you will see in our business, because obviously our claims depends a lot on where it's getting serviced. If the OEMs increase their labor parts, if they increase their spare part price, the claim ratio would move up immediately. If the hospital increases their charges, that would move up. But then how does the company react to it? And is able to bring it down while ensuring that the customer service is at the highest of order is what the game is. And that is what Srini was saying, that over decades we do this. So this is not, again, to me, a cause of worry.
Sure. And the last question is, how do you see the GST impact on motor business loss ratios as well as in the retail health insurance business?
So if you look at now, GST had two components. One was input tax rate for distribution, which would be there. Second was because of reduction of GST, you saw increase of car sales happen, which obviously the motor business goes up. Also, if you look at retail health business, that also moves up. At the same time, hospitals also and OEMs also have other benefits in spare parts and all. Now, if they pass it on to customers, as was the expectation by the government, then that would also bring it down. But there we have to see proof in terms of how much they really pass on to customers. That would be those impacts. So you will see increase in the business in these lines of businesses. You will see the impact in loss ratio if they pass on the benefit they have in terms of be it the spare part cost or be it in terms of the medical equipment cost which should be there and things being put it together. So this is how it's going to play out overall.
But in terms of the impact, unlike the life, the impact is only on the health and PA business on the output tax side. So proportionate disallowance, because of the variety of product lines, many of which continue to be under GST, the company has enough flexibility to be able to manage it in the long run. Temporarily, there may be a bit of blip as these things play out, but we'll wait and see.
Sure, sir. Thank you. That's it from my side.
Thank you. Next question is from line of Mayur from Wealth Managers. Please go ahead.
Good evening, sir. Thank you for taking my questions. Just wanted to confirm, am I audible, the operator?
Yes.
Yes.
Okay, thank you. So, again, congratulations to the entire team of life insurance. I don't want to sound very poetic, but clearly within the Bajaj Group, a new star is getting born. We had 2 stars and now the 3rd star also coming up. So that's a great and heartening thing. And it's not after one quarter. It is consistently, we've been watching it over a couple of quarters now. So a great execution of the strategy which has been there. Just on the question side, actually, there was a question on this listing, and response to that was also about the regulatory changes, and it will help companies with higher capital adequacy which we have. But in the light that now the profitability engine of the life insurance is firmly in place, and the fact that at a Bajaj Finserv level, we may have requirements of capital. Does it make sense to have a dividend policy, and will that lead to some correction in the capital adequacy? How do we see that aspect from a parent perspective, and is there any thought process on that?
In perspective, I think the two insurance companies have been paying dividends since last 2018, if I'm not mistaken. And in fact, both of them have more or less paid back more than the capital that the PFS and our ex-partner Allianz have invested in these businesses. So that was already on. Now, as we go forward, this year, obviously, we could not take any dividends because we are in the midst of a change in shareholding, and obviously, you cannot pay a dividend because that's not part of the arrangement with Allianz that we will share dividends with them. But once that is completed, we will review that. There are multiple things in relation, as I mentioned earlier, in terms of RBC, in terms of Ind AS, in terms of composite licenses, and the surplus capital and the utilization of those capital. And by Finserv itself, I think BFL is a dividend-paying company. Bajaj BALIC are paying dividends. Our capital consumers are currently only our health business and our AMC. And therefore, it is not significant capital that we need at the moment. So we are quite comfortable at this stage. We will see once the Allianz transaction is over what to do with that capital.
Okay. Yes, and actually, the second question was also on line of the health. We have almost infused more than 1,200 crores, if I see it right on that number on the health and this side. When do we see, we are seeing almost 30 crores quarterly run, roughly losses which are there. When do we see that part turning around, and what would be our milestone and benchmarks over the next 3 years for that business in terms of profitability or something which we can monitor quantitatively and qualitatively both on that side?
Devang, you want to take that?
Sure. So way we look at the health businesses, our objective is to build a differentiated platform which takes the requirements of all stakeholders. So this ecosystem has quite a few stakeholders. Obviously, the consumer who consumes the healthcare is the important stakeholder, but there are insurers, there are providers or hospitals or doctors which have slightly conflicting priorities. So, but there is a value creation possible globally, it's seen, and hence it can be done. But our priority at this point of time is to create digital interface and put health data to use for users as well as payers or insurers and providers. So I think two things we are focused on as far as profit trajectory is concerned. One, how do we launch more services which balances requirements of all stakeholders? And second, how do we drive volume which will eventually lead to operating leverage? We are seeing operating leverage play out quarter on quarter, but it needs to steepen up, but it will happen with more and more new services getting launched.
Mm-hmm.
That is our broad view on the business. Unless, if I have not clarified your question, you can ask again.
No, so since I'm not asking a quarterly or a yearly, but from a milestone over 3 years, do we anything to look after from a more quantitative aspects? While qualitatively you have highlighted what is at play and how to look at it. Anything quantitative benchmarks which we would have internal in terms of the numbers or over a 3-year, 4-year period?
So I think we watch two North Star metrics. Point number one, how many health transactions are we processing? That is the most important North Star metric for us. Second, are we able to create use cases from those transactions insight? Now that is slightly qualitative. But I think that is the two most important monitorable for us as a business. And as far as quantitative financial output is concerned, we are very clear in next to next financial year, we should break even. So we will moderate our investment appropriately.
That is FY27.
28.
Nima, would you like to, we are also now started dealing with life companies, SAHI companies, other GI companies, selling riders, products, services. So that's a start we have made, and we want to scale that.
Okay, great. Sir, I have a slightly short-term, just numbers understanding. My financial understanding on insurance is not very great, so pardon me with that. But just wanted to understand, we have around 120 or some odd crores impact of the GST which we have taken in the quarter. Is it going to be recurring for 2 quarters? Is the understanding right, the numbers? Or is it all the impact has been taken? That is one. And that is the impact which we see on I think VNB, but will it also, how has been the impact on, will there be an impact on embedded value or anything on the other side, which will there be an impact of that as we go?
Sure. So let me answer both the questions. I think the 112 crore number that you are referring to is after tax pack. Now, you're right, there are 2 elements to it. Like I mentioned in case of NBM, there is an impact of all the policies that were issued until 21st September, because as we keep paying renewal commission on renewals, we wouldn't get the GST credit, right? So out of 112 crores, 73 crores is back book, as we call, and this is one-time impact. This is not going to recur. 39 crores is for the business that was written in last 8-9 days, and that is recurring. But I will make the same point that I made for NBM. There was a significant product skew in those 8 days towards non-ULIP. So on an annualized basis, this impact will not be as proportionate. But I think it is important to understand that the number that you are looking at is without taking any action. And as Tarun mentioned earlier, it's been more than 2 months. So it's close to 70 days since the GST changes were announced, and we have already taken number of steps to mitigate the impact on PAT, VNB and margin. Coming to EV, we have already reported there is an impact that has been reported on our EV. It comes to 44 bits of EV. Because our NAV is very high, because we have high net worth, as a percentage of this, it is 102 bits. I think that would be more rightful measure if you want to compare our back book impact on EV compared to anybody else. I'm not sure, Mayur, I think those were 2 questions you were looking for.
Yeah, I think I got the answer. Can I squeeze in one more question with the permission?
Go ahead.
Yeah. So, sorry. Actually, it's on BALIC itself. So, definitely we are in the first year of a very significant leg up in our NBMs from, closer to 10, 11, 12% kind of range to now, even if we exclude the 17, 18, 19% kind of ranges, and we had these targets of 20%, reaching around 20% we could have. So, the question is, yes, it's the early journey. We understand it. But it is in sight. It is in sight of us, and we are almost there. The question was, do we now in a position, will we stay in this band for some more time, consolidate and grow the scale and profitability both, or do we think we will be looking at the further next journeys from here on over the next 3 years, more moving in line with where the tier 1 margins for players are? Will that be the trajectory, or will we consolidate here first for couple of quarters or years and then move up the next leg?
Yeah. So, Mayur, there's a lot of things you've asked on that. But just to be clear, I think we'll take it a step at a time. And yes, there has been a leg up. It's and I really I'm happy that all of you are acknowledging that big significant change. I would not jump ahead of my time, and I would not make too many forward-looking statements yet. We take it step by step. There is also now and we're handling, the entire sector is looking at the GST impact. We are working on it, and I guess the sector first has to gobble up that, and then maybe talk of times beyond that. And I guess there's going to be another quarter when we'll meet, another quarter after that as well. And we will then be in a better position to respond to this.
Great. Thank you, and wish everybody all the best for the next quarter. Thank you so much.
Thank you very much. As there are no further questions, I'll now hand the conference over to Mr. Raghavesh for closing comments.
Thanks to all the participants for joining the call, and a special thanks to the management of Bajaj Finserv for giving us the opportunity to host the call. Thank you, sir.
Thank you. Thank you, everybody. Thank you, everybody.
Thank you very much. On behalf of JM Financial Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.